So now we will be discussing the CAPM model, which is your capital asset pricing model. So in the preceding section, we saw that under the CAPM theory, beta is the appropriate measure of a stock's relevant risk. Now we must specify the relationship between risk and return. So for a given level of risk as measured by beta, what rate of return should investors require to compensate them for bearing that risk? So to begin, we will first define these following terms. The R with the hat is your expected rate of return on the ith stock. RI is the required rate of return on the ith stock. This is the minimum expected return that is required to induce an average investor to purchase the stock. And R bar is the realized after the fact return. So you have already studied what is expected and realized return. Expected was when you were dealing with futuristic data. So you're dealing with a future prediction. Whereas realized is your average return. So it is based on historical data. So something that has already happened. So it is already realized. हो चुका है ये. Whereas required rate of return is the minimum benchmark, which means that investors need this much return for them to make an investment. So let's assume, for example, that you require from a stock that it should give you a 10% return. So this means that you will not invest in the stock unless and until you expect that the return will be equal to or higher than 10%. So if let's say the market is doing very well, so you expect that that particular stock is going to give you a 15% return. Your minimum benchmark was 10%, and the stock, you are expecting that the stock will actually give you a return which is higher. So you would be willing to buy this stock. Whereas if the stock would be giving an 8% expected rate of return, market अच्छा perform नहीं कर रही, आप assume करें कि 8% ही return होगा. So in that case, आपके minimum requirement ही 10% है. आप if you expect that the stock is going to give you an 8% return, you would not be willing to invest in that stock. Okay. Now, this might be possible that your requirement was 10% and you expected that, okay, it will give you a 15% return. But something went wrong. Maybe there was a strike or something, due to which they realized the after the fact return. So after 1 year, you calculated your return and it came out to be only 8%. So realize is something that has actually happened. Now, RF is the risk-free rate of return. In this context, the risk-free rate is generally measured by the expected return on long-term US Treasury bonds. So because this book is a US book, so you are considering US Treasury bonds. For if you're calculating the risk-free rate for Pakistan, it will be the long-term Pakistan Treasury bond rates. Okay. Now the beta I is the beta coefficient of the ith stock. Rm is the required rate of return on a portfolio consisting of all stocks, which is called the market portfolio. So the return on the market portfolio on the whole market is represented by Rm. RPM is the risk premium on the market. So risk premium is calculated by Rm minus RF, and it is the additional additional return over the risk-free rate required to induce an average investor to invest in the market portfolio. So let's assume that the risk-free rate is 10% and the RM is 15%. So the stock market is paying a premium of 5% in this case. Remember, 15% minus 10%. So the risk premium will be 5%. Now अगर एक बंदा बॉन्ड में इन्वेस्टमेंट कर रहा है गवर्नमेंट बॉन्ड्स में, so these are the safest type of security. If he is getting a 10% return from there, then in order for that person to enter into the stock market has got to offer a higher return. जब तक return ज़्यादा stock market नहीं ऑफर करेगी, so that person will not be willing to invest in the stock market. स्टॉक मार्केट भी 10% का रिटर्न दे रही है, बॉन्ड भी 10% का रिटर्न दे रहा है. सो बॉन्ड वुड बी द बेटर ऑप्शन बिकॉज वहाँ पे रिस्क कम है. नाउ बिकॉज द स्टॉक मार्केट इज मोर रिस्की, द रिटर्न ओवर देयर हैज़ टू बी हायर. So how much higher does it have to be? That is your risk premium. Risk premium on the ICE stock is represented by RPI, and it is the risk premium of the market multiplied by the beta coefficient. So the CAPM model basically answers these questions. For a given level of risk as measured by beta, what rate of return should investors require to compensate them for bearing that risk? This is answered by your CAPM model through your SML equation, to be exact. Your SML equation is the security market line equation. Basically, this equation tells you the relationship between risk and return. We have said again and again that if the risk is high, then the return has to be high, but we had no idea of measuring this. कि risk कितना high पे कितना ज़्यादा return increase होगा. Now, because we know that the relevant measure of risk is beta, based on this we can calculate what should be the required return in that case. So this is your SML equation. The required return is equals to the risk-free rate plus the premium for risk. The risk-free rate is denoted by RF, and the premium for risk is denoted by the market risk premium multiplied by the stock ICE beta. The market risk premium is calculated by RM minus RF, and stock ICE beta is calculated by beta I. So this is your final equation. RM minus RF gives you the market risk premium. So the required rate of return is equal to the risk-free rate plus the market risk premium multiplied by beta of the stock. So let's look at an example. How does this CAPM model equate risk and return? This is the example. Assuming that the average return of the stock market is 11 and the risk-free rate is 5%. Okay, it says 5% over here, but this is a typo. The risk-free rate is actually 6% in this question. So this is the risk-free rate, and the average return on the market is 11%. Calculate the required rate of return for stock I that has a beta of 0.5. So so this beta has a stock, this stock has a beta of 0.5, and you need to calculate what is the required rate of return in that case. So you can use the CAPM model. The risk-free rate is 6%. The market return is 11%. Again, risk-free rate is 6%, and the beta is 0.5. So if you solve this, your market risk premium is 5%. This is your RPM. This is the market risk premium. And this is giving you a return of 8.5%. Now moving ahead, calculate the required return for stock J, which is riskier with a beta of 2. So you can still use the CAPM model. The risk-free rate is still 6%. The market risk premium is still 5%. You calculated in the previous part. But you will replace now this beta by 2. So this should be beta RJ, since you're using beta J. If you calculate this, your return for stock J is 16%. So you can now compare. When the beta was when the beta was 0.5, the required return was 8.5%. Now once the beta is high, which means the risk is high, the required return has increased from 8.5% to 16%. So जितना ज़्यादा रिस्क उतना ज़्यादा ही रिक्वायरमेंट है रिटर्न की. Similarly, calculate the required return for an average stock which has a beta of 1. So if the beta is 1, then this is mirroring the stock market. So the return should be equal to the average return of the market. And the average return of the market was 11%. So let's put it in the formula and see if that's the case. Okay. So if you calculate it, now you're replacing beta with 1 and your answer is coming 11%. So this was the return of the market as well, because this is an average stocks. Okay, so this is basically your CAPM model. So over here you can see that once the beta was 1, the return was equal to the market, which is 11%. So this is your average return. And if it's a riskier stock, the return will be higher, and if it's a safer stock, the return will be lower.